Dear students, welcome back to Property Law. So that's HOE 6011, and well, we'll be looking at mortgages today. So we already finished sales last time. Now, just to remind you, I believe homework 2 will be up very soon, depending on, of course, when you see this video lecture. And then homework 3 has also been put up in Moodle, so that's the Nemo DAT principle. Well, you won't find much about that particular aspect in the in the property law lecture notes, and so you will have to sort of find your way around that thing and maybe check for sources online or in some law journal articles or books. All right, so that's the Nemo DAT principle. And what else? Well, I've already put up some dates for the exams. So these are some possible dates. Nothing is fixed yet, and I've got some feedback from some students. So if any of you have any other things to talk about in this regard, then there's this Moodle online discussion forum, and then we can accordingly finalize the dates if everybody's okay, and then that's one more thing under control. Yeah, of course all the information is in Moodle, so everything should be clear cut and easily understandable. So where were we last time? We looked at sales, and we looked at various aspects of how sales work, and what are the different issues that arise in that context. And then I also put up some information. For example, there was this whole issue about sale and stigmatized properties and disclosure and things like that. So it's all over there. Of course, this particular course is just a very basic introductory course to property law. So you see all sorts of material being used, from all sorts of jurisdictions. So whether it's European countries, US, UK, so we have a mix of everything here. The idea is not to confuse you. I mean, it's just to sort of lay out the various facts that play a role in understanding a particular part of the law. And that brings us to mortgages today. And mortgages are also very interesting. Of course, whatever you see nowadays, especially in our parts of the world, Estonia, Finland, Germany, France, everywhere. Basically, what we are seeing is the easy availability of credit, and that plays a very big role. So let's say theoretically you have 500,000 euros in your pocket, yeah, cash, all right, money in your bank account or wherever, and now you want to buy a house. So how would you go about doing this? Well, maybe the house costs 500,000 euros. So there you are. Problem solved. Go pay the money to the seller, like we discussed last time, and you have certain rights and obligations and duties. And based on that, well, the sale is completed, and congratulations, you have bought a 500,000 euro house. But sometimes maybe you're not playing it smart. Yeah, maybe there's a different way to deal with this issue. What could that be? Let's say the house costs 500,000 euros, and there is also a very nice flat apartment for 250,000 euros. Yeah, so obviously the house is a bit out in the suburbs, and the apartment is more in the city. Hence, the prices are the way they are. Now, what could you do? Well, if you play it smart and if the system allows you to do this, you could buy the flat, 250,000, pay it in, cash, bank transfer, whatever, and the flat is yours. And then you could go to a bank and you could say that you want to buy a house, and the house costs 500,000 euros, and you would like to take a loan from the bank. And what sort of loan would this be? Well, maybe you say that you want to pay upfront 50%. I don't know why. Yeah, but maybe you want to. And then you can get a 20-year loan. So you pay upfront 250,000 euros, down payment for the house. And you take a loan from the bank for 250,000 euros. And now, well, what do you have at the end of this? You have a house in your name, you have a flat in your name, you have a mortgage for 250,000 euros for the house. Now, what could you do? Well, you could rent out the flat and get 1,000 euros a month or whatever, and you could put that rent money into your mortgage monthly installments. You see what we're getting to over here. You're getting a mortgage for a house for 2%, 20 years. It's not such a big problem. And you now have a situation where your flat pays for the mortgage loan. So, you rent out the flat and you live happily in a house. And at the end of 20 years, you have a house and a flat in your name and steady income from one, and a steady nice house on the other side. So of course this is the beauty of a mortgage, all right. And as you can imagine over here, it sort of really gives consumers or users of such arrangements a lot of flexibility. So, I mean, if Euribor rates are so low and negligible almost, and the banks are flush with cash or credit, and we all see how, for example, there is inflation, there are fears of, how the pandemic may play out, which is why a lot of property prices are still going up because people are buying properties. And well, not everybody buys it with cash upfront because that would be a bit silly, especially if you have such good mortgage rates. So you can see how this sort of arrangement with a strong banking system and a strong consumer protection system, and of course a strong legal infrastructure can really help to raise additional capital or do all sorts of things. Then, of course, you have a first mortgage. You could use it to, you could use the same house, for example, to get a second mortgage. Well, it's a cash flow situation, right? I mean, you're paying the money to the bank every month, the installments. So the bank is happy with you. You have two properties. And now let's say you see a summer house for sale in somewhere in Finland next to a nice lake, and you want to buy that property, but you don't have any more money in your pocket. So that doesn't matter, right? I mean, you have two properties in your hand, a house and a flat. You have steady income from one, so the bank could even give you a second mortgage. So all of these are possibilities, and of course, the bank doesn't really care what's the color of your skin, or what color car you have, or what color jacket you wear. They just care about their money, and as long as you can assure a bank that your your liquidity conditions are fulfilled, and you're not in danger of going bankrupt, or you're not going to run away, and the bank has a guarantee or a surety that you will get the you will handle the mortgage loan properly, and the bank will get its money back with interest. So if that's the case, then of course, that's the bank's job, right? Uh, we deposit money in the bank, so bank has cash, and now, of course, that's a very simplistic way of looking at it. And what will the bank do with this cash? It gives you a bit of interest payments or things as a depositor. And now, with all this cash that's lying in the bank can lend it, or give mortgages or loans to people for businesses, properties, transactions, whatever. So, of course, what's very important over here is that there are two interests which need to be balanced. Now, we all can say, yeah, the banks are bad and the banks are evil and the bankers are just greedy or whatever. But, they're giving you the money and they need a guarantee that they will get their money back. So it goes both ways. The law has to protect the rights of the mortgagee, that's the bank, and remember this, and the rights of the mortgagor. The mortgagor, again, remember this, is the one who takes the loan. The mortgagee gives the loan. All right, simple stuff. Of course, if you mess up the terminology, it can sound very ridiculous then. So you have to be very careful about certain concepts over here. And as long as the credit risk is taken care of and protected, and the bank has a surety that it will get its money back, and you have a surety that the bank will not try to rob you or something, then you are both okay. Of course, this doesn't always work in a vacuum, and that's the beauty of the European Union. For example, you have national states, the member states, and then, of course, you have national laws, and then there are some laws which come from the European Union. So most of these are directives, and then some are regulations. And most of you, I hope, by now know the difference between directives and regulations from the EU. So there's also a very interesting aspect over here that although this is simply a situation that would come under contract law or the law of obligations, it is after all a written agreement. There are some consumer protection aspects that need to be covered and taken into account. So you have this unfair contract terms directive from the European Union. So I've put up a little article on that, article on EU law and mortgage possession cases. So again, read this. Yeah, it's very interesting because it sort of balances things out. Just because the bank is giving you money, of course, the bank doesn't own you. And conversely, just if the bank has given you 100 million euros, you don't own the bank either. There is a restriction on what either party can do. And of course, the law understands that the banker, the mortgagee, is in a very strong position. And of course, you have to be given some degree of protection. So again, a very interesting aspect of how European Union law can play a role in something that we would have presumed is not relevant. But again, you should see that, for example, we have Swedish banks in Estonia. So Sweden is a different country, Estonia is a different country. So there has to be some sort of mechanism in place that the European Central Bank plays, so that people from Finland, people from outside the EU, people from inside the EU can get certain access to funds and mortgages. So it's a very interesting area, and of course, there's a lot of regulation that comes up over here. Regulation is important because the 2009 scandal, financial crisis that came out, was because this whole lending, mortgaging, went out of hand, and suddenly it was not very controlled, and banks were doing crazy things, and nobody really understood what was going on, and then the whole system just sort of collapsed. But we are looking at mortgages of immovable property, so not like student loans or something, but rather aspects that deal with immovable property. So we have a mortgage that's defined over here: transfer of an interest in specific immovable property for the purpose of securing either a loan or a debt or any other engagement which gives rise to a pecuniary liability. And pecuniary would mean something to do with money. So the transferor is called a mortgagor, the transferee is a mortgagee. Just remember, the mortgagee is the bank, all right? Because there's a lot of aspects over here. Basically, what they're saying is, I have a property, and so I am transferring it to the bank, and in return, the bank is giving me money. So this can work out in different ways, different variations. So just to keep it simple, mortgagee is the bank. All right, problem solved. So what are the various aspects of mortgage? Well, there are some definitions again over here. What are rights and obligations, and what are the meanings? So you can check all of that over here in the notes. And the mortgagee basically has a right to satisfaction of a claim secured by the mortgage out of the pledged immovable. And so it works as I said in the previous example. You go to a bank, you want to take a loan, and you want to buy a flat or a house, and well, the flat or the house that you get is the security plus something else if the bank wants it. And they check your income statements and whatever, and your liquidity issues and everything, and based on that, the bank gives you a loan, and now you have to pay back regularly. And there are certain fixed terms, and it's a detailed contract lays out all the issues that can arise. Of course, this is a 20, 25-year, 30-year issue, so it's going to be long term, and a lot can change in this period of time. So of course, this contract, such an agreement would cover a lot of fine prints and issues about all sorts of things. And so of course, you could have this major, you could have act of war, you could have like a pandemic, something else going on, and there are a lot of other instruments that come into play. So for example, you are husband and wife, and then you take a loan jointly for the house. You can also see how this works. Number one would be both parties have a 50-50% obligation and rights and duties. Secondly, you could have an insurance scheme which says that if one of the parties to this arrangement, either the husband or the wife, passes away or dies for some reason, then you have insurance, and the insurance will pay 50% of the mortgage sum. So you see, there's a lot of stuff that goes on over here. Uh, it's a well settled part of law, but also it can give rise to a lot of complications. And as the bank is in a very strong position, the bank may be tempted to sort of push you by giving you more loans so that you can't pay your money back finally, and now you have a serious cash flow problem, and then you become bankrupt, and in that case the bank can auction your properties. So there are a lot of things that can go wrong. After all, it's a 20-year period. Nobody knows what happens in 20 years. Nowadays, with the coronavirus pandemic, nobody knows what will happen next month. So of course, there are a lot of uncertainties which the law needs to cover. So we look at different types of mortgages. Again, nuances, small differences, nothing that you would expect to be extraordinary, but they all have their own aspects to them. And this is important as a lawyer, because based on this is what you would be drafting the agreement under the law of obligations, or the law of contract, as it's called in the UK, or other English speaking countries. So there are a few differences that play a role. So for example, you could take a mortgage without delivering possession of the mortgaged property. So that's one aspect. Second way is the mortgagor, the one who takes the loan, ostensibly sells the mortgaged property to the bank, mortgagee, with the condition that if there's a default in payment of the mortgage money by a certain date, then the sale becomes absolute, and payments being made once the sale shall become void. So there are a lot of these different aspects to that issue. Then a third way is where the mortgagor delivers possession to the mortgagee. So how would this work? I have a flat, and I go to the bank and say, hey, I want €1,000,000, and I have a flat in Old Town. It's worth €1,000,000. So here are the house keys, and you have the flat. It's yours. The bank can do whatever it wants to do with it. I'm taking a short loan for 5 years, and then once I pay back the money, then I get my property back. Yeah. And in the meantime, what can the bank do? Well, the bank could rent out the property, or do all sorts of things. Again, a different variation. Then the mortgagor binds himself or herself to repay the mortgage money on a certain date, and transfers the mortgage property absolutely to the mortgagee, with the condition that the mortgagee will retransfer on payment of the mortgage money. So again, what's happening here is there's a transfer of interest, but not actual transfer of the property. In that context, possession may not be given, but there's a clear transfer of interest. Or old school way, very old school, is nowadays, of course, everything is online, but earlier you had these property deeds, the documents, and the original documents with a nice stamp on it, marked with, I don't know, Gustav the Seventh, King of Sweden, or whatever. And then it would have a nice outline and explain in a cadastral survey sense where the property is situated, who was the owner, how it became in this person's portfolio of ownership, what are the various features of this property, all sorts of things that you would have in an old fashioned document. And then these were still around even 30 years ago. not so much nowadays. Nowadays everything is online. You have uh, the register of properties online, so you don't really need to have physical copies, but it's always nice to have. Anyways, so in the olden times, for example, you could just give this document to the bank, because this is a very important document. Without this document, you cannot sell the property, unless you go and get duplicates made, which would not be a very simple task. And so there are all of these issues. And so you could just give this document to the bank and say, well, you keep the document, and when I've repaid the money, I give you back all the money, and then you can give me back the document. So what sort of money are we looking at over here? Of course, there is the principal sum of money, and then there is the interest that accumulates, and then you have to pay back the money based on the calculations. And of course, it's the way it starts off is you have made an upfront payment, and then for every year there's a table which outlines how much money you have to pay. And well, of course, this would also depend on interest rates, but there's always a sort of a cushion, and it explains how much it should basically be, unless the world collapses, Russia invades the European Union, or something like that happens. Somebody drops a nuclear bomb somewhere. Well, those things are out of your hands. So there are two aspects that come up over here. One is, what are the rights of the mortgagor, the person who takes the loan, and what are the rights of the mortgagee, which is the bank. When we're talking about rights, there are also liabilities and duties, and these two are the main aspects that play a role. Most property laws would presume that they have covered these areas, but as we saw from the EU directive and the article that's there in the notes, of course, there is some level of consumer protection, which is a bit different now, because we're talking about property law, and now we're talking about consumer protection. So there's a sort of a gray zone overlapping, which as the examples in the article stipulate, are there to help the mortgagor, because you are just an individual, and the bank is this big Goliath, with tons of money, and they make on minting money and doing other fancy things with money, and we don't even understand the numbers that we are talking about over here. So the right of a mortgager to redeem, so that's the right of redemption, a very, very important right. Basically, what it outlines is that I want a loan, I go to the bank, and so the property is mortgaged or whatever, immovable property in my name, and I have the loan. But that's it. Once a mortgage, always a mortgage. It will stay a loan. It cannot automatically become a sale document. Yeah, like we saw last time, what are sales? The bank can't just say, okay, Pawan, forget it, no need to pay back. We just buy the property using the same mortgage document. No, you can't do it like that. I have a 20-year period. I have to pay back the money, and based on the loan agreement, and I'm going to pay back the money. And you can't say after the 5th year or the 12th year that, Pawan, we don't want your money. No. I have the right to redeem my property, and if the bank wants to convert it into something else other than a mortgage, then the bank has to go to the bank for that, to the court, and sort this out, or it has to be a different document that has to be signed properly. Now it has to be a sale agreement or a conveyance of a sale, like we discussed in the last lecture. But in that case, the mortgage, you cannot just cancel mortgagor and mortgagee and make it vendor and purchaser. No, you can't do those sort of things. You cannot just amend a mortgage document and make it something else. Once a mortgage, always a mortgage. And this is very important, because it's the right of redemption. You have the right as a mortgagor to get back your property, and nobody can restrict this right. And even if you see section 349 of the Estonian Property Act, or 352, for example, it stipulates exactly what I'm stating here. So it's a universal sort of requirement. All right, and So that's number one. We are looking at over here rights and liabilities of the mortgagor. Number two would be obligation to transfer to a third party instead of retransference to the mortgagor. It could be that I have this property and I took this bank loan, and then I can tell the bank loan um, people, the bank people, that once I pay back the money, then don't send the property back to me, but transfer it into my daughter's name or something, yeah, whatever. Right to inspection and production of documents, yeah, that's also possible. Then access to mortgage property and accession as well, improvements to mortgage property. So all of these are aspects that come up over here. Talking about property 20 years, so of course there can be a lot of things that can go wrong. The roof leaks, for example, and you don't repair it for 15 years, then of course it's going to be a problem. All right, now you have a wooden house, you don't take care of the moisture content, you end up having mushrooms growing in the wall, right? If there's a fire, it can cause structural damage. A small fire, not a giant fire. But all of these things are relevant. If the water pipes are busted or leaking, or if there is a lot of theft happening or vandalization, all of these play a role here, because the bank obviously would want the property, which is a security for the loan, to be well insured. Yeah, that's a key criteria. Again, if you take a loan and you have this property and it's a subject matter of the mortgage, and now you decide that you want to go and live in Colombia or Brazil for 7 months, and you want to rent out this to somebody on Airbnb. Well, the bank will say, no, no, you can't do that, because this is security for us. We don't care who you are, where you are. We want our money to be safe and secure, and we don't want some weird people coming over without insurance and treating property as if it's their grandfather's property, because it's not. And although it's your property as a mortgager, well, the bank has a vested interest. Remember, we spoke about these terms. So of course, there can be a lot of these issues that can arise, and this is again legal, of course. Yeah. So what happens if there are improvements made in the middle, while the mortgage is continuing? So let's say I have a house and it's a simple house, and things are going good, and then because I don't know, Donald Trump builds a golf course next to my house, and now suddenly the my house has gone up in value, the property prices. Well, that's good. Yeah, bank will be very happy, because I took a loan for 250,000, but my house is now worth not 500,000, but maybe 1 million. Yeah, so that's very good for the bank. But conversely, of course, what if I don't know, Donald Trump comes and buys a house next to my property, and because of that, all property prices go down, because there are still a lot of people who hate Trump for some reason. Yeah. So what happens now? Well, this can be an issue, right? I have a house. It was worth 500,000 euros um, until yesterday, and now today the value has gone down to half the price. Well, there's an issue here, right? Of course, the bank will be a bit worried about this, and the bank would say, "Hey, Pawan, now you need to come up with another security, because we are getting worried that how property prices can come down 50% in your area." So, of course, as a bank, we are not sure whether this is sustainable over the long run, and we have a 20-year relationship. So, what the hell? So, of course, a lot of these consequences can arise, and so there are rights and obligations. So implied contracts by the mortgagor, for example, again, you can see over here, in case there's a litigation, can I, the mortgagor, just say, hey, it's not my problem, it's the bank's problem, and walk out? No, you can't do that. Now, okay, this is not about immovable property, but this example sort of illustrates this. So I had this one neighbor, and she got a phone, a nice fancy iPhone, and she was, it was a leasing arrangement or a loan arrangement, as you call it, but for movable property. And then she dropped the phone in the toilet for some reason, and it stopped working. And so she said, well, if my phone doesn't work, why the hell should I pay the bank or the mobile phone company or the reseller, whoever, Euronics or whatever? So she stopped paying. Can you do that? No, of course you can't do that. You have a loan, you have to pay. If you don't pay, what can they do? Well, of course they won't hang you upside down. They don't do such things anymore, not in Europe. But what they will do is they'll put you in a blacklist, and your credibility and credit rating goes down. Then you can never get a loan again. So in a similar way, if you take a mortgage for a house, yeah, this is a serious thing. You can't just be flippant about it and say I don't care. Well, you have to care, because it's not just you; it's also the bank that is involved over here. So of course, these are all covered in this regard. Waste by mortgage or in possession, for example, um, covers this area, and security and issues that arise with them. So a lot of problems that happened in 2009, 2010 were basically because banks were giving loans to people who shouldn't have been eligible to get housing loans. Now I know this sounds bad, when I say it the way I say it, but the point here is, I mean, if you can't afford it, you shouldn't go for a loan that you will have serious problems in paying back, because this is real life, and there are duties and obligations. You can't just say I don't have money. That's not how things work. So when the bank started giving money to people who had no business getting a loan, then of course there would be defaults, and this becomes a bigger and bigger bubble. And then they did the subprime thing, which was the bank just sort of digitized all of this, and turned a €1 million loan, $1 million loan, for example, into sub loans. Yeah. And then made them into instruments, and gave some to some other bank in the UK and some bank in Iceland, and they started trading in all of these crazy things. And so of course you can see how this lack of regulation resulted in more and more loans being created, and more bad mortgages that were failing all the time, and nobody had a clue as to which bank owned what exactly now, because everything had been just demonetized in a very weird way. So of course, in such a situation, you can see how this can be quite a problem. So if you have a strong mortgage environment, everything is stable, then of course, people can afford to have nice fancy houses and fancy cars, and a nice consumerist society. Not very sustainable, but it's fun. It's fun to have a nice big house with a Lamborghini outside, and that's possible with the mortgage system. So what are the rights and liabilities of the mortgagee, the banker? The bank. So of course, the big bad bank, as they like to say it, well, it's not so bad. I mean, they do give you loans, so they have certain rights, and the biggest right that they have is the right to foreclosure or sale. So of course, if you cannot pay the money in time, then the bank can give you an extra bit of time. The EU directive in this regard for consumer protection allows certain things, but after a point, the bank is going to say, hey, you need to pay up. And if you cannot pay up now, well, what to do? So, well, in this case, the bank can sue to foreclose. Sue to foreclose. All right. The bank can't just come to your house and kick you out and take off your underwear and say, all right, now go and sit in the park or whatever. No. You have certain rights, and of course the bank needs to go to the court and go through the whole process and make sure that you are legally debarred from getting back your property, from redeeming your property. And now in this context, you now have foreclosure. So the bank has the right to sue. And who can they sue? Well, the mortgagor, who has to repay the money, or if the security goes down, or is partially destroyed or whatever, then to make sure that the security is taken care of. Or if I take a loan, I'm the mortgagor, and then I start selling the house to different people, then of course the bank can step in and say, hey, what the hell are you doing, Pawan? Why would you do that? We have a 20-year loan, and now you want to sell the house. Well, you have to tell the bank what your plans are about all these things. And so of course, what happens if there's accession to the mortgage property? Basically that would mean you had a property and now it's become bigger for some reason, naturally or whatever. So all of these play a role, but the important element to remember is rights of the mortgagor, right of redemption, and the right of the banker, the mortgagee, is the right to sue for foreclosure. And these two are the most important takeaways from this. And then, of course, you could also have certain rights of the banker who is in possession of the property. So they can they sue if somebody messes with the security of the property? What are the rights of the mortgagee in this regard? What if the mortgagor is not cooperating? So again, all of these issues. And what can the bank do? Well, just because it's your house and it's in their possession, they can't use it as a party place or something. Well, they have to use it in a reasonable manner and not destroy the property or anything of that sort, because after all, it is security. So these are the two main aspects. And I would also request you to read this article, EU Law and Mortgage Possession Cases. It's about Irish legal system. Yeah, but it's a very nice article from 2019, which is quite refreshing if you realize that I am this antiquated guy, who likes vintage cases and always talks about stuff that happened 100 years ago or 50 years ago as if it was yesterday. And so this is very interesting to see. Of course, Ireland suffered very badly during the economic crisis. There were these countries. There was Portugal, Italy, Ireland, Greece, and Spain. And this economic crisis of 2009 really left a huge mark. But these cycles come all the time. They come and go. If you're Finnish, for example, you could ask your parents about how much fun they had in 1990s. Yeah, that was a big crisis as well. And then again in 2000 there was a mini crisis with this these software companies and the software bubble, as it was. So again, it had an impact. And then 2009 2010 again had this sort of huge issue. And now we have a pandemic and it's affecting again. There will be people who will finally go bankrupt. Tourism is down, hotels, restaurants, nightclubs, sports clubs, all of them are affected. So of course, these are these cycles. And it's very important to keep in mind that a 20-year loan is okay. 25 is good. 30-year is optimal. And I know a lot of Finnish students, for example, who have managed to get loans from a Finnish bank. And the security is maybe granddaddy's property or something somewhere in Turku or somewhere. And then you get a loan, and now the loan is for a nice swanky flat in Tallinn in the Rotterdam area, or Pirita or somewhere. So there are a lot of these options that arise. Of course, would a Swedish bank be comfortable, or a Finnish bank be comfortable in giving a loan for property that's outside Sweden or Finland? Well, it depends. German banks may not be very comfortable with that, but other countries have other banking systems. And of course, it all depends on the health of the bank now. And if the bank is just giving out loans and it's a scam, it's a mafia run organization, then you can see how this can badly impact society. So the laws, property laws that deal with mortgages are very, very crucial. You can use a mortgage to finance your business or whatever, or buy real estate or do all sorts of things. So there are a lot of tax implications, legal implications. And as lawyers, or just generally as somebody who grows up finally and buys their own property, you can see how this plays a role. Of course, there are a lot of people who don't think that they should be buying properties. They believe in renting or leasing. So we'll look at that next time and try to understand not just their mentality, but also what are the legal issues that can arise. So until then, thank you for listening to me, and we meet again next week. Goodbye.